Hello, ladies and gentlemen. My name is Blair Braden, co-host of Money Talk. Today is August 28th. We're going to be discussing the momentous month that the S&P 500 has had, the month of August. We're going to be talking about the tech sector. We're going to be talking about typical market conditions this time of year, the Federal Reserve, inflation, and timing the market. As I said, today's August 28th, so the month of August is not concluded. There's one more day left of trading for August. That'll be Monday, the 31st. However, up to this point, the S&P 500 is having its best month in 34 years, being positive. The Dow Jones is flirting with being positive on the year with this week's returns, probably did today after its close, but it's been a pretty good August, as we can see with all of those things. Another interesting tidbit that came out this week, the U.S. tech sector is now larger than the entire stock market of the European economy. To put that in real terms, the U.S. tech sector is valued at about $9.1 trillion versus the European stock market being valued at somewhere around $8.9 trillion. In 2007, Bank of America reported that number was 4 times smaller than it is now, or meaning that the European stock market was 4 times larger than the U.S. tech sector. So it's been a wonderful 13 years for the U.S. tech sector, surpassing Europe as far as how large their market capitalization is. I've had a lot of questions recently about the stock market and, of course, what we see coming specifically with the election. So I wanted to talk a little bit about seasonality of the stock market. There are truths of the past or events that have happened that have led investors to believe that there's certain things that are truths. There's an old saying in the market of sell in May and go away. What that means is, well, take your profits in May because typically the summer months are not quite as good. Historically, September has been one of the worst months in the stock market looking back over at history. Again, in election years, we typically see volatility leading up to the election, followed by November and December being wonderful months in the market, again, typically creating a positive return in the stock market during election years. I said typically a lot. Is 2020 typical for you? I would think not, and I believe that is very possible this year that we're going to have things that aren't so typical happen. So seasonality of the stock market, I believe, is really hard to put any credence in this go around, this time of year. But again, typically speaking, we're entering into September, of course, which can be a pretty rocky month in the stock market. If it's typical this year, I wouldn't be surprised. If it's atypical this year, I wouldn't be surprised. But we do expect that we would see a little bit of volatility, especially leading up to the election, but see no reason why November and December still couldn't be good after the election concludes. Part of the reason, I've harped on this a few times, is the Federal Reserve's policies and their view on inflation. I want to talk about inflation quickly. The Federal Reserve would like to see inflation rise. Why? We've heard inflation, I've talked about it in the past, as maybe a risk in the future. So why in the world do we want to see inflation on the rise? It all comes down to wanting to be competitive on a global stage. So think about it this way. If inflation rises, the value or the worth of a dollar decreases, thus making us more competitive on a global stage to be able to do exports. So if we're not inflating, the rest of the world is, it's much harder for them to buy our goods. That is one reason why the Federal Reserve wants to see inflation. We haven't seen inflation to speak of really in the last 10 years again, and it's below the Federal Reserve's targets. On Thursday of this week, Jerome Powell, they're at their annual conference up here in Jackson Hole. He had a talk about this specifically and the Federal Reserve's role in inflation and where they see themselves going moving forward. His comments were different than in the past because the Federal Reserve in the past has been okay with inflation not rising, not being at their target, and letting bygones be bygones, saying, that's water in the bridge, nothing we can do about the past. What was different about this conversation with Jerome was he was talking about if we see inflation starting to rise, we're going to let it rise for a little while to catch up for some of this time period that we haven't seen inflation. So they're looking backwards in a way and trying to play some catch up and allowing policy to allow some catch up. And that's the biggest difference in his talk on Thursday than what we've heard him say in the past. What that means is most likely they are going to be keeping interest rates capped and lower longer than maybe we expected. Again, trying to spur that inflation. We'll see if that happens. This year has, I believe, taught a lot of investors different things. One thing that I hope that people are learning more about or are willing to accept more is that timing the market is typically not a profitable endeavor. It's very hard to do. How many of you listeners would have thought that we were hitting all-time highs with different indexes at this time, knowing that COVID was happening, knowing that a recession was coming, knowing that a somewhat contentious election might be coming up here? You know, all these things that we're hearing out in the news and everywhere would tell us, our guts, man, we need to stay away from the stock market. Let's time ourselves out of it. Timing ourselves out of the stock market has proven very faulty this year. And again, I just want to try to encourage people to focus on your long-term plan. Accept market volatility as a natural reaction of this market. Stop trying to time this thing. It doesn't work. Warren Buffett does not time the stock market. Warren Buffett buys investments from companies that he knows are great companies that he intends to own for a very long time. With that, we're very excited. This next week coming up, we have our Social Security seminar. This will be recorded, so you don't have to attend necessarily on Thursday evening. If you can't make it, you can go back and watch it. We get a lot of questions on how and when to take Social Security. We're going to try to dive into that, hopefully give people some more tools in their belt when it comes time to making that decision as to when and how they take Social Security. If you missed our last webinar on ESG investing, environment, social governance investing, and how that plays a part of our investment process, I'd encourage you to take a look at that on our website. The video is available, and the webinar rather. We want these education events. Knowledge is power. We want to give you the knowledge. We would love it if you could take a look at that ESG seminar, learn a little bit about that type of investing and the credence that comes with it, as well as if you can check out the Social Security seminar that's coming up, especially if you're getting closer to that age, so 60 plus type of age, might want to take a look at that. But with that, we love questions. Please send them our way. Thank you all very much. Have a wonderful weekend.